Okay, time for another Q&A. I'm still in Costa Rica. Let me just move my microphone around here, and I'm still outside, so you're going to hear some background noise. Let's begin. Assume there is a pure academic professor with pure academic finance pedigree. No industry exposure or past experience, so you're saying assume any old professor out there, versus pure professional with rich industry expertise in finance. Which of them would be have more potential to become a academic in his field? Listen, you can always train somebody in research methodology. You can always train somebody to be a researcher, and the professional will already have a good idea of the variables of interest. I would give it to the industry expert, probably. Well, I mean, this is not deterministically, but probabilistically speaking, I put my money on the practitioner any day. Recently watched your old video on increasing minimum wage. Saw you made the case that increasing minimum wage is a headwind for population study at universities, specifically decreasing the net present value of cash flow return on their investment in education. Because when you go to school, you can always get minimum wage, right? So when you go to school, what you're hoping is you get some increase over minimum wage, and that you would increase over time. But if minimum wage increased, then the gap shrinks unless everything gets a delta. So if you increase minimum wage 10%, you have to increase all wages 10%. Otherwise, the present value of your excess return would decrease. We do this in markets as well. You get the return on the market. You did not get that as your return because you could have gotten the risk-free rate for doing nothing, for taking on no risk. So we always talk about excess return, excess over the risk-free rate. Excess income is excess over the minimum wage. And then that's just a statement. It doesn't appear to be a question. Do you think the growing pace of cognitive domain emulators for now, presenting similar case mentioned above, seemingly decreasing the return on investment in university higher education, when an average population could be better off by becoming a plumber or other blue-collar jobs? Well, this is the problem that I think society has committed, or the mistake that society has committed over the years. If we think about the distribution of ability, and here we're talking about cognitive ability in a population, it is normally distributed. And if you know anything about your normal distribution, 68% is within one standard deviation, IQ of 100, you get to 115 and 85. That's 68% of your population is there. The rest belong to the wings, 32%, so 16% here, 16% here. It was long believed that the carrying capacity of higher education was about 15% of the population. And I think that's true. However, we push about 45% of high school students into university. That's the problem, is we put a lot of students into university. We sell them on this idea, and many of them probably would have been a lot better off getting a trade as opposed to going on for higher education. Next question. I use Google's Gemini app on iOS, and it gives answers similar to Perplexity. I have the Gemini app. I do the same thing. I get the same thing. But this was Google, the Google search, but you just simply click on AI mode. And what you saw is what I got. We are in big trouble with Peter Ritardo and Stephen Mirren. Yeah. My first question is related to Fed rate cuts. Why could the major effect of a rapid decrease? What could be the effect of a rapid decrease on effective funds rate? Well, the money market rates would follow along with it. It would squeeze a lot of money out of money market rates. It would have a lot of benefits in a lot of places. I just don't know if the capital market would go along for the ride. That would be the biggest threat, is if the capital market sees that and says, whoa, we don't like this, and suddenly you get a 5 or 6 or 7% 10-year because everyone just wants the hell out. The bigger effect probably would be on the U.S. dollar. That U.S. dollar would drop and gold would skyrocket. Can the U.S. handle a revaluation of the U.S. dollar that quickly, that low, without causing major dislocations in trade? Well, which is kind of what they want, I think. Second question related to AI. Money managers are investing a large sum of money into commercial mortgage-backed securities, SASB and ABS, to accelerate the construction of data centers. Are they? Adding the capex for energy or natural gas will put pressure on AI, but I recall that you said that AI is deflationary. My question is related to the monetization of AI. What if they cannot find a good way to monetize an AI and make it viable and profitable? Can we reach a point of diminishing returns earlier than expected? Well, the deflationary effect of AI is in the user's hand, not the producer's hand. So all these models that are being produced, whether they're going to be profitable or not, I don't know. But the use of the model in my hands increases my productivity incredibly. Sorry, so my unit costs drop dramatically. Now, if I were in a space where I had competitors all doing the same thing, it would be a race to see where our margins would end up based on where our revenues would drop to. So the productivity gains are what the users make of it. The profitability are what the producers get out of it. I think you're going to have a reckoning when it comes to profitability. But deflationary it still will be. Do you agree? Do you have 30% withholding tax on your Canadian investments? On my Canadian investments, no, because the Canadian account is in a Canadian corporate entity, and it does not have withholding tax. And what about your U.S. holdings? They have 30% withholding, but we follow a strategy of any bonds or zero coupon bonds. Any securities that we hold, we try to make sure we have low dividend payers. What do you think Clayton Christensen would have said about AI? Disruptive, sustaining, or efficiency, innovation? Disruptive. It is disruptive. It is a whole new layer to the economy. It's a whole new operating system of how the economy operates. So I would say disruptive. Absolutely. I'm drinking a Canadian coffee right now. That is coffee with maple syrup. Jealous? I'm following up with my comment about Google AI mode. Here's what I get with your prompt. I know I've had a lot of people send me screenshots already saying this is what I get, this is what I get, and all I can answer is say, well, I showed you what I got, and I gave it 2 chances. I have since tried it again. I do get better output now, but the first couple times I tried it, I simply just got links. So I don't know what that was about, but I am getting better output now. I don't know if I'm sold on it or not, but with time. There we go. Core premise 1, the economic constraint is shifting from supply to demand. Historically, economic growth was limited primarily by supply constraints. Today, that constraint is weakening. I agree, there is no supply constraint unless you purposely create a supply constraint, like shutting down the global economy or raising tariffs enough to eliminate the supply of a critical material from a particular other country. China's industrial capacity demonstrates a shift. Its immense output of tangible goods, part of an explicit goal to achieve post-scarcity, already generates surpluses so large they contribute to geopolitical friction. That's just true. It implies that for many physical goods, production capacity already exceeds effective global demand. You don't even have to look to China, look to the U.S. We get this every 2 weeks. We get capacity utilization. We're sitting at 77.4% capacity utilization, 3/4. 3/4 of the potential capacity of the economy is being used. AI will cause massive productivity shock. That is true. AI tools were used to refine this text, illustrating a minor productivity gain. Well, don't be so tough on yourself. It's not a minor productivity gain. You've given me 2 premises. This is the structure of a logical argument. I cannot argue with your premises. So if your conclusions flow from your premises, you have a logical argument. Now, it may be unsound, but it's logical. Let's find out. Given that productivity for tangible goods may already exceed demand, yes, what remaining unmet market demand exists to absorb the new productivity unlocked by AI? Lower prices. Lower prices. Listen, if I go to American Eagle and I buy a pair of jeans influenced, of course, by Sydney Sweeney, because I have good genes too, and they're $80, I'll buy a pair. But if they say, look, if you buy two, you get one free, I'll think, well, why not have some inventory? Lower prices. Lower prices is what clears inventory. If Corvettes were $10,000, I'd buy one a year, right? I'd have 20 of them, but they're not. Let's see if we can talk to GM about shifting its Corvette production to China and see if we can't make 3.5 million Corvettes a year instead of 350,000. If applying AI to manufacturing tangible goods only exacerbates existing surpluses, its economic utility in that sector is questionable. Well, I don't know that sentence is a logical sentence. Applying AI to manufacturing. What do you mean applying AI to manufacturing? I don't see what you mean. If you mean AI embedded in robotics, we've been automating factories for decades. So you could say that robots already run factories. They're just not humanoid robots. Your dishwasher's a robot. It washes your dishes. It's just not a humanoid robot. We've been living with robots for decades. And washing machines have already had smart sensing technology in them for years. So I'm not sure what you mean by AI to manufacturing. You still have to manufacture the good. If you mean within the production system to reduce scrap, to make it more efficient, okay. Only exacerbates existing surpluses. Okay, so we have to make a distinction here between operating leverage, like asset-heavy businesses and asset-light. An asset-heavy business has to produce a certain amount, it has to spread its fixed costs over a certain number of units. This is why you have overproduction in auto manufacturing and in steel production, because if you run at a lower capacity utilization, you cannot even cover your fixed costs. So you must produce a bunch of output. But businesses are not stupid. If they're producing below their shutdown price, remember level 1 microeconomics, if they're producing below their shutdown price, they will shut down. They will take capacity offline. Airlines do this all the time. Have you ever noticed that every plane you get on is full? It can't possibly be that people are traveling that much. What they do is they size the plane for the amount of people traveling so that it's always full. And if not that many people are traveling, they reduce the number of routes they do so that everyone has to pick a Monday, Wednesday, or Friday to fly. Businesses do the same thing. They'll reduce their capacity to meet the market because nobody wants to produce at a level where they say, look, we're not making any money here. There will be shakeout. Businesses will fail. This is what it means. It's not as if you're going to go into a world where, everyone's producing and no one can buy all the surplus and it's just building up. Businesses will fail. While AI may have more potential in the services sector, it does. What is the actual depth of unmet demand for services? Well, you can't find enough nurses. You can't find enough truck drivers. For the longest time, the construction industry couldn't find enough carpenters and construction workers. So services are not scalable, especially when you get into healthcare and you have an aging population. You need to ramp up healthcare. Well, an operating room can't operate if you don't have the doctors and the nurses to be in the operating room. This is why hospital REITs have had such a tough time. Is if you have 4 operating rooms but you can only staff 3, guess what? You only run 3. So the hospital itself is having a hard time paying the lease on the hospital building. AI may be able to help out in a few places there. What specific courses, books, thinkers, or authors? Only 4 categories? Provide a serious, detailed analysis of this specific economic problem. The collusion of an AI-driven supply. Well, I don't think any. We're just at the beginning of this. I don't think that there's anything out there. So I don't know the answer to that one. If a recession were to occur in the United States, for example, if the Federal Reserve reacted too slowly in cutting rates because the effect of tariffs created confusion, and the economy slowed sharply against expectations, possibly leading to deflation. How would you manage your investments in such an environment? If you had the specter of deflation, if that's what the numbers were printing and the Fed wasn't moving, the capital market would already lower yields. Duration would perform magnificently under that scenario. Well, I would, in a theoretical world, duration would perform well. These days, I have no freaking clue. I don't know why duration is behaving the way it is, but here we are. To make it more concrete, oh, hang on, I'm going to finish the first one. In that scenario, what would be the step-by-step priorities to follow? I don't know. Step-by-step? And which areas would you see attractive for investment? You know, I can't answer that question because here's what it comes down to. It's not just a matter of deflation. You tell me what's going on, and I'll tell you what we can invest in. You tell me why we have deflation, I can tell you what to invest in. If we have deflation because of a global-wide productivity boom because of AI, well, that's one story. If we have deflation because of a global slump in demand, because of some big exogenous shock that sends the world into a depression, that's another story altogether. So there is no one answer to that question. You tell me what caused it, you tell me what's going on, and I'll tell you what I would think at that point in time. Both traditional and alternative investments typically behave around the cycle of a recession. None of them perform well. Just before it sets in, okay, I'll pass on that. You're asking me to hold a seminar. Any thoughts on King advocating that companies should report their earnings every 6 months instead of quarterly? I'm of two minds on this one. Number one, Trump wants it because he has a publicly traded company and he's just tired of spending the money to get it done. He's doing it for himself, not for anyone else. That's mine number one. So I'm against it, simply because it is to the benefit of one individual without thinking if it has any benefit to anybody else anywhere. He wants it so that his company can spend less money so that he can make more. End of story. That's it. Number two, yeah, quarterly probably seems like a pretty rigorous schedule when you're in perpetual earnings mode inside the finance department of every large corporation. By the time you get one quarter done, you have to start working on the next quarter and the next quarter. And this relentless pace of meeting every quarter. I think companies could probably do better if they report every 6 months. Do we really need quarterly data? You know, if you have every 6 months, you might take some seasonality out of it. I don't know. If you had a conversation about semi-annual reporting that grew organically, that had wide consensus, that had a conversation for a couple of years as we move towards it, I would probably say, yeah, it seems to make a lot of sense. But when the king dictates it, I got a big problem with that. Even if I agree with it, when one person dictates it, that's my problem. And he's dictating it not because he says, listen, I know what's good for everybody, but you have to be forced to take your medicine, so I'm going to give it to you. He's saying, no, I know what's good for me, so it will be so for everybody. There's my problem, is the dictating to me. Like, let's say that I want to eat chocolate cake, and you come in and you say, you will have chocolate cake for dessert. Well, I got a problem now. Do you see what I mean? Do you get that? Even though I would have done it anyways, you dictating to me makes it a whole other thing altogether. So, there are my two minds. At the 6:30 mark, is it correct to interpret the 77 basis point spread between the 2-year yield and the Fed funds rate as an expectation of 6 cuts over the next 2 years based on the calculation of 77 over 2? Well, it is an average over that period of time, right? So over 2 years, you're going to have, I don't know how many meetings here that it's pricing in. It's going to be, you got 80-year, 16 meetings, you got 3 cuts, back of the envelope, math really quick, multiplied by 2 as a shortcut. I'm sure if I looked at where they were planning the cuts and I went out on the forward curve and I weighted all the cash flows over that period of time, I'd probably come up with something different. But back of the envelope, I'm sort of thinking that way. But would I be able to defend my dissertation on that? Absolutely not. Rolling Stone's parent company takes Google to court over traffic loss to AI overviews. Well, I didn't hear that. That's interesting. Thanks for responding to my question on doing research a few weeks ago. Appreciate your insight and thinking of it more. I realized that I am more interested in the academic side of research as opposed to company or equity research. Dear God, what's wrong with you? Such as writing papers that study market structure, variables that may affect a stock's liquidity, investor behavior, and so on. I do hope you seek the help you need. You want to do academic research? Well, I shouldn't be so hard on it. I want to approach this kind of research so that it's rigorous, useful for the financial body. Oh, that's what everybody starts off by saying. But you know what's going to happen? You'll write that in your letter, because when you apply to a PhD program, you have to write a statement about how much you love research, how the question drives you on. This is what you want to do. These are the topics I'm interested in. I have an endless curiosity. They want to know that you're going to be a great researcher. And everybody starts off saying, I'm going to change the world with my research. And then you get a job as an assistant professor and a tenure clock goes tick, 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 and you don't have time to change the world. You got to add a brick on the wall, a brick on the wall, a brick on the wall, and you need 6 or 7 of those bricks on the wall to get tenure. By that time, you're embedded in a research program, and you're not leaving just to start it all over again. It's a nice idea, but the reality of publishing gets to you. You need 6 to 7 good journal articles for tenure. You're going to have to write 20 to 30 to get that much published. In 6 years, 20 to 30. There's no time. There's no time to change the world. None. You need guaranteed publications. So you're going to grab a data set and you're going to run your numbers and you're going to say, aha, I found this. Then you're going to write your hypothesis saying, I wonder if this is true. Meanwhile, all the time you know it's true because you need publications. And if your data doesn't quite fit, you know what you're going to do? You're going to eliminate this case and you're going to get rid of that case and you're going to pare down the data set and you're going to say, oh, look at this relationship. They all do it. They all do it. But don't you lose that virtuous focus that you have. Maybe you will change the world. Or maybe the world will change you, especially that world. I hope to pursue teaching finance. Don't ever say that if you're going to a PhD program. Don't say that you love teaching. You love research. Plain and simple, you love research. And if you have to teach, you have to teach, but you love research, right? They don't train teachers. They don't hire teachers. They hire researchers. Do you have any advice on how and when to make the transition? I don't know anything about your life at all. I wouldn't be able to advise on when or how to make the transition. The younger, the better. PhD programs aren't really too concerned about your age. I've seen 25-year-olds in these programs. I've seen 50-year-olds in these programs. They're not too concerned about your age because you can publish well into your 80s and 90s. They don't really care. But it is not as intellectual or reflectively intellectual as you think. You're going to write research grants because you need money. You got to bring money in. You need money. You're going to write research grants. You got to teach classes. You got to go to conferences. You got to review papers. You got to review chapters. You have to have 4 different categories: contribution to the school, contribution to the program, contribution to the field, right? And you need points in all of those things. It is a job. It is a job. So you better love that stuff. I didn't. You laid out investment ideas where you have most faith long-term, copper duration. Yeah, I am losing faith in duration, by the way. So copper, I'm still there. Can you comment if that view has changed? Just did, given the potential rate cutting cycle. We had 25 basis points, and duration threw another hissy fit. What changed, from Wednesday morning with TLT over 90 to Thursday at noon with TLT at 89? Everyone was expecting 25 basis points, and you got 25 basis points, and suddenly duration threw a hissy fit. I don't like it. So I don't know what duration wants at this point, but I am losing my patience with it. I think it's fair to say I've given it enough time, and someone's making noise in there. I don't know if you heard that in the background. Seems AI mode in Costa Rica is different. Here's my Google. Maybe it was. I don't know. In the event of a financial or economic crisis, cash is often seen as a protective asset. In a financial or economic crisis, I don't know that I would say that cash is a protective asset as much as everything else is risky. Okay, well, yeah, I guess the other side of that equation is, if your cash is at bank affected by the crisis, you could lose access to it. That's why there's insurance. Whereas this risk would not apply in the same way to money market securities, because they are client assets and the cash is on the banks or the brokers. Good luck making that argument. Money market, any fund goes down, it can only return the money it has left. Your money's lost. What are you going to do with it? You're better off in a bank. Are you more inclined towards Keynesian or monetarist? I don't know that it is useful to sit in one camp or the other. I think what is useful is to understand where Keynesianism is useful and where monetarism is useful. They're both useful paradigms, both with data to back them up. But I think, much like being way on the left or way on the right is always wrong, being in the center makes more sense. Being in the center economically makes more sense in that Keynesianism has something to tell us, but so does monetarism have something to tell us. And let's take the best of both worlds rather than saying one or the other. But if I had to lean, if I were center right or center left, I think I would be center Keynesianism instead of center monetarism. Yeah, that would be a fair statement, I think. When looking at the inverted yield curve, you mentioned the short-term rates are pricing in a cut, which makes sense, as that is the nature of the market. Why haven't long-term rates priced that in as well? You tell me and we'll both know. Beats the hell out of me. Because when it comes to the 30-year, and it's a useful tenor, where are you going to go? If you don't like the U.S., where are you going to go? At some point, the yield is, if every other yield is dropping, at some point the yield is so attractive, you got to say, look, I'll take it if no one wants it. You said momentum is the best paying factor ever. Why is that? Because it is probably the most watched factor, and momentum begets momentum. So that when you have momentum, other people find it and they jump in on it, which causes the prices to go higher, which causes more people to be attracted to it, which causes prices to go higher. It is the best paying factor, but it ends up becoming a very crowded factor after a while. So what are your rules for risk management? When you said your position was losing 20, you start moving the delta towards zero at 20%. Yep. When you have 30%, you do risk elimination, which means delta equals zero. Yep. What do you mean when you said that are harvesting volatility? That's hard to explain without actually showing you. That's sort of a thing I do down here, so we will pass on that question. Book a ticket to Costa Rica and you'll get all the answers to that question that you want. GDP now is estimating 3.4% growth for Q3. Has done that impact your rate cut at predictions? Nope. No. No, that really doesn't change anything for me. Are you planning to do any CFA revision streams for people taking the level 1 in November like you did earlier? No, that is, I didn't do the level 1 revision, by the way. Somebody else did. Oh no, I did. I think I did macro. What did I do? I did something, but no, I'm not going to be doing that. Do you think Michael Burry does any risk management for his 11.6 million Lulu holding, 21% of his portfolio? You got a dollar sign in front of that 11.6, and you're saying that's 21% of his portfolio. I believe he's got way more money than me, and if 11 million is 21% of his portfolio, that would make me richer than him. I think you mean 11.6 million shares. $11.6 million. That would seem rather light. His average price is $260. He didn't announce his position until Lululemon was like under 200. It was like 190, 195 when he announced his position. 260. I mean, I don't know that that's true. I'm not quite sure it is 260. I'll take your word for it. Does he do any risk management? Absolutely. Absolutely. What to interpret out of this other than increasing wealth inequality? Americans in the top 10% income cohort made up nearly half of total consumer spending during Q2. So what wealthy people are inherently going to spend more? You got to take that with a grain of salt here. A wealthy person will go buy a $50,000 watch. A poor person will buy a $500 watch. They both bought one watch. It's not like wealthy people are buying way more watches than unwealthy people. It's just that when they buy a watch, it's the equivalent of 100 watches for the average person. A wealthy person will buy a $600,000 car. That's $60,000 vehicles for the average person. So we can't say, wealthy people spend 50%, they make up 50% of retail sales, they're buying half the stuff. No, they're buying the really expensive stuff. Somebody's got to buy the $30,000 bottle of wine, right? Somebody's got to buy the $120,000 art piece. Somebody's got to buy the $250,000 racehorse. So when they spend money, they're just making such big footprints for one thing. I don't know that I would read it linearly like they're buying half the stuff that's out there. But it says, you're asking, so what, wealthy people are inherently going to spend more? Yeah. And by the way, that 10%, I want you to understand something about the 10%. It's not a static 10%. At any given point in time, I would say that 30 to 40% of Americans have at one point or another in their life been in the top 10%. You're free to make it to the top 10% and go right down to the bottom 10 and then right back up to the top 10. Retirees who are in the top 10% are now in the top 20%, and at some point they'll only be in the top 30% because they're spending down their wealth. So when we say, the top 10% own this, it's not a static 10% where we could say those people right there. You have this social mobility so that at any point in time, that somebody who's in the top 30% could have said, you know what, 3 years ago I had a business and it didn't do well. Then they were in the top 10% or even the top 1%. That's the beauty about the Western capitalist system, is it gives you social mobility so that the top 10% is not a fixed number. Big day today, Fed rate cut. Yeah. I know you are not a friend of unions and strikes. What argument would you make against strikers? Well, put it this way. Nobody wants to walk the picket line. I think that after your contract is over, you got 3 months of negotiation followed by 6 months of mediation. If you get nothing after that, it goes to arbitration. Nobody goes on strike. With labor laws the way they are, there's really no need for these kind of strikes. Not only that, a strike is an economic weapon of mass destruction. not only do you affect the tax base, but you affect all the businesses around you. You affect innocent lives that have nothing to do with this. So no, I say you keep working. You keep getting that paycheck. It's better than strike pay for 4 months or 6 months. It's way better than strike pay. Keep working. You negotiate in good faith for 3 months. You can't get anywhere. It goes to mediation for 3 months. You can't get anywhere after mediation. It simply goes to arbitration. And arbitration is somebody listens and says, okay, here's the deal, and you must both accept. No strike. No strike pay. Now, if you did that, would union workers have to give up one paycheck a year to the union? I don't think so. We have this beautiful sunset going on right now. I know you can't see it. Let me move my microphone towards the sunset. Have a look at that. I know you can't see that. With the negative rhetoric in the U.S. and other parts of the world, what do you think needs to happen to bring everyone together and avoid turmoil? What needs to happen? I don't know. You need a very charismatic, influential person in the center that can bring everybody to the center. I just don't know if that's possible in the world of social media that makes its money out of polarizing the population. Who do we want to blame for the sheer amount of hatred going on in an economy today? Not economy, a society. Left hates right, right hates left. I blame social media because social media puts you in these echo chambers and it magnifies your argument back to you. So you say, yeah, I am right. I am smart. It's the other side that's stupid. You want to bring society together? You want to repair the tapestry of society? Ban social media. Get rid of Facebook. Get rid of YouTube. Well, don't get rid of YouTube because that's the only thing I use. Keep YouTube and keep LinkedIn. Ban everything else. How's that? Anyone in investing in water stocks? You got a number there. Do you calculate returns in CAD? Yep. Use it as your base currency instead of US for the CAD portfolio. Yeah. Got a REIT question. Been looking at cannabis growing industrial REIT IIPR. I know nothing about this one. I'll tell you that right now. Dividend yield awesome, about 13%. High dividends are not awesome. They're in REITs. They're usually a sign that something's wrong. Option IV is great too. Their AFO covers the dividend but has dropped some recently with lease defaults by growers. Looked into their main tenants and many are unprofitable but still can at least break even on top. Well, none of that sounds good to me. So you see the risk. You see why it has a 13% yield and why its options have that IV. It would be nothing I'd be interested in if you're asking me about that. What is Powell's reasoning about downward pressure on employment is due to decrease in both demand and supply of labor due to immigration? I think what he's trying to say is that supply is down, but so is demand. So that the situation in the labor market seems to be imbalanced, even though demand is dropping. Supply is dropping at the same time. So unemployment can stay fairly constant, which hides the weakness in the labor market. That we like to say, holding all things constant, if we just looked at the demand for labor, we would have much higher unemployment. But because the supply of labor is adjusting as fast as the demand for labor is adjusting, the unemployment rate seems to be masking the underlying weakness in the economy. Mortgage rates falling to the lowest in nearly a year, almost 3 years now. Home loan refinance applications shot up 58% last week. The refi index did, yes. Refinancing accounted for 59.8% of mortgage apps, up from 48 the previous week. Just curious, what would be the implication of this on MBS? Well, it would accelerate the prepayments, so that the speed, I think it's called the PSA speed, increases. If you have all of these refis, if any of those mortgages were collateral against an MBS, they would be paid out. And then that money would have to reinvest at whatever rate any new mortgage issued by the agency companies are. Other contraction risk due to prepayment. Other than that, does rates going down increase the value of MBS? Well, yes, If you're holding an MBS, yes. If you're holding a mortgage REITs usually hedge out the interest rate component and lever up the spread. But the spread is usually tighter at lower interest rates. So the lower the mortgage rate, the tighter the spread. So it does benefit them. They are cutting interest rates to support America's slowing job market. In essence. Oh, we're almost done. 5 more questions. Any thoughts into why mortgage REITs are down after the cut? I'm literally guessing that because the expectation was bought and news were sold. I would bet that it's more about one cut in 2026. They are forecasting 3 cuts this year, and their terminal rate next year says 1 cut in 2026. Does anyone believe there'll be only 1 cut next year? You have 5 meetings in 2026 ex-Powell. 5 meetings to the end of next year, and you think you're only going to get 1 rate cut out of Trump's Fed? Hardly. So I think that's why REITs took a move down. Do you identify or consider yourself investment professional, more of leaning towards a pracademic? Well, I don't do any academic research. So I would say that I'd be more of an investment professional now than a pracademic, but you go through a PhD program and there are certain things that you carry with you, a certain way of looking at the world you'll never shake, you'll never get rid of. So I guess a well-informed investment professional, well-informed by an academic background. How's that? Why aren't you shorting SPY? Because it has not worked for three and a half years. It has not worked. Other than little bits here and there, it just hasn't worked. I mean, I'll short it and then I'll give up, and I'll short it and then I'll give up. But if I short it again, I'm an idiot, right? 2 times you can make a mistake, but if you go making the mistake 3 times, something's wrong with you. So no, I'm not shorting it. Surprised you were shorting in H1 2025, but now given 23 times forward earnings. Yeah. Twice bitten, really shy. How's that? Trying to reduce my beta exposure, but also stay in position that will benefit from rate cuts. Small caps. What are some of the positions that will benefit from rate cuts but have low beta? Banks. Big time banks. Financials. Big time. Could you explain the reverse repo price piece in your market outlook? Having trouble conceptualizing that on the Fed's balance sheet. I have money. I'm a money market fund. I have extra money. I need to invest it. I can go into the marketplace and I can bid up money market securities so that I can get something. But I would push the price up and push the yield below 4.25%. So the Fed says, hey, if you got money to invest, you come and see us. We'll give you 4.25% on your money. That's called a reverse repo. And that's it. Right now the sky is pink and beautiful. And I'm at the end of the questions. I'll see you on Sunday.